Hello, my friends. Today is August 24th, and this is Markets Weekly. So this week, another good week in markets. It looks like the major indexes are just slightly below all-time highs. Is this going to be a double top, or are we just going to break through and zoom on to infinity and beyond? I have no idea. We'll find out in the coming weeks, but it looks like we're at a pretty interesting juncture. Today, I want to talk about three things. First, of course, we have to talk about what happened at Jackson Hole, where Chair Powell officially pivoted towards a rate-cutting regime. Let's hear what he said. Secondly, what stood out to me the most the past week was the US dollar, just relentlessly sold across against major currencies. Let's talk about what could be driving that and what that might mean. And lastly, on the economic news front, the big news last week was the downward revision in U.S. jobs created by about 800,000. That's a very big downward revision. Let's talk about what could be driving that and ponder whether or not that's politically motivated. All right, starting with Jackson Hole. Now, for some context, Jackson Hole is a very beautiful place in the state of Wyoming. And every year, central bankers around the world fly over there and basically have a big party. Oftentimes at those events, they have also very important policy-oriented speeches. A couple years ago, Chair Powell was at Jackson Hole, and he gave the speech saying that there would be some pain. He was going to hike rates a lot, probably cause a recession, and he was going to bring inflation down. Now, this week's Chair Powell, though, was basically the opposite of the Chair Powell a couple years ago. Let's hear what he said.
The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
So, the time has come. He is telling everyone unambiguously that he's going to be cutting rates at the next meeting, and how much he's going to cut and to what extent it's going to be data dependent. Let's think about what brought him here. Now, a couple years ago, inflation was very high, but over the past few months has come down a lot. The Fed's favorite measure of inflation, PCE, is about 2.7%. So, that's just a little bit above the Fed's target. Chair Powell has been saying over the past few meetings that he wanted to have more confidence that inflation was getting to 2%. Today, he said that he had that confidence. What he's thinking about right now, though, is not so much inflation, which he thinks is going to get to 2%. What he's thinking about is the labor market. Now, the labor market, the unemployment rate was at multi-decade lows not too long ago, but the unemployment rate has been ticking up steadily and is now around 4.3%. One of the notable quotes in his speech was that Chair Powell felt that the labor market today was actually weaker than it was in 2019. So that is a clear signal that between his two mandates, full employment and price stability, he's becoming more concerned about full employment, and so he's going to pivot. Now, the market, of course, has known this for some time. Well, I'll say this. So there are different markets. You have equities, you have rates, you have commodities, you have FX. Now, every market has different people involved in it, and they have different degrees of awareness of how the Fed works and how other regions work. Now, the people who are most focused on the Fed are the short-term interest rate traders, stir traders for short. These guys, well, they bet basically what the Fed will do over the coming meetings. So they're very attuned to how the Fed is thinking. Now, heading into this meeting, the short-term interest rate futures were already pricing in cuts in September and about 100 basis points of cuts for the rest of the year. Now, this speech did not have a big impact on them. They marginally priced in a little bit more cuts throughout the year, but became more sure that we would get 25 basis points in September, some possibility of 50 basis points. The STIR community, of people like myself who have been telling you for some time that the Fed is going to cut in September, we already knew this. But it seems like the other markets were not as aware, and so we had pretty notable moves in response to Jackson Hole. Equity markets obviously up a lot. Equities like rate cuts. Notably, though, the dollar sold off significantly. The thinking, of course, was that as the Fed lowers rates, interest rate differentials between the US and the rest of the world narrow, and so the dollar sells off. Now, it's unclear just how much rate cuts we will get throughout the year. I continue to think that we probably get 25 per meeting for 75 total, but that's going to be completely data dependent. Since the Fed has openly told us that they're more concerned about unemployment right now, the jobs market reports we get each month will be more important than the inflation reads. So all focus will be on the September jobs report number that we get the first week of September, where if we have continuing rise in unemployment, I think we could very likely get 50 basis points in September. But if unemployment rate stays around 4.3% or even improves, which to note, many people who watch this think that last month's rise in the unemployment rate was maybe a fluke. In any case, if unemployment rate stabilizes, I think we get 25 basis points, and we'll just have to see. Honestly, I don't think the Fed knows. They are really data dependent. Some other Fed speakers at Jackson Hole were articulating a framework of being steady and measured in their cuts. So that's really other Fed officials trying to lobby everyone else as to what the Fed will do. No one knows. We'll have to wait for the data. Okay, the second thing that I thought was really noteworthy the past week was just the relentless weakening of the US dollar. Now, if you look at the US dollar index, zoom out a bit, you'll notice that we're coming basically to the lower ranges now, about 100, which in the past has been support. Now, looking deeper against dollar crosses, you can see Euro USD basically surging, going to the moon. Dollar against pound also surging, going to the moon. So there's been very strong selling of the dollar over the past few weeks. And I'm kind of scratching my head a little bit because when I look at typical indicators of currency strength, it doesn't stand out to me why the dollar would be selling off so much. Now, typically people think, well, currencies are determined by interest rate differentials. So let's look at the two-year yields of, say, the US, of Germany, of the UK, and see how things have been going. Well, obviously, the US is cutting rates, and so the two-year yield is lower than the overnight rate. But if you notice what other countries are doing, they're also cutting rates as well. So even though we are in a rate cutting cycle in the US, so is everyone else. So the interest rate differentials, when you look at the two-year segment, not really changing all that much. Doesn't seem that would justify the tremendous dollar weakness. I think some people whisper that U.S. inflation is coming down, so U.S.'s disinflation is more than other countries, and maybe that plays into a role. But I'm not too sure if currencies trade on real rates rather than nominal rates. Another way people look at currencies is basically through economic growth. Oftentimes, countries that have strong economic growth see their currencies appreciate as investors pour into the country to try to invest. Now, when you look at economic growth, comparing the US with other countries, it's really clear that the US is doing a lot better. In fact, many other countries, Eurozone in particular, have been doing very poorly. So it's strange looking at growth rate differentials to ponder why the dollar would be selling off so much. It could simply be just momentum, a lot of CTAs seeing that the dollar is weakening and piling in. But I think it's an interesting thing that stood out to me. Now, if the dollar continues to sell off, I think this would be quite negative for all dollar assets. The reason being, as we've discussed before, and I've written about in my blog, is that there are many, many foreign investors in U.S. assets. U.S. capital markets, the deepest in the world. U.S. Has a lot of really cool stuff like technology, AI. You don't really have any cutting edge AI stuff in other countries. So a lot of foreign investors have been pouring in and buying US assets. Now, they can hedge their currency exposure, but FX hedging has been pretty expensive the past few years. So these guys are likely unhedged. Now, even though they're making money on their, let's say, equities or their treasury investments, they're losing money on their currency investments. And they've been losing a lot because the dollar has been depreciating a lot. Now, on the margins, I would imagine that this could cause some foreign investors, because of course they're having losses, to sell out of their U.S. equities or their treasuries and go back home. Basically, a blow-up of the current carry trade that we saw similar to earlier in the month. So I think that's a notable risk right now if the dollar continues to depreciate. And reason for caution. The U.S., honestly, is a huge source of destination for foreign investment. And so there's a lot of potential selling that could happen. All right, the last thing that I want to talk about is the ginormous downward revision in jobs created. So the way that the jobs data works for the U.S., every month, as we all know, we have the non-farm payrolls report, where the Bureau of Labor Statistics, the BLS, goes and they surveys a lot of 119,000 companies, accounting for about a third of all the jobs in the U.S. Now they don't survey everyone, they survey just a third instead of everyone. Obviously, it's a statistical sample. And based on that survey of 119,000 employers, they come up with an estimate as to how many jobs were created or lost each month. Now, obviously, this is just a sample, and every now and then you have to update the model to make sure that what you're sampling continues to be representative of the economy as a whole. Now, these updates come in the form of these benchmark revisions, where instead of sampling 119,000, they take the time and go through the state-level unemployment claims and survey about 95% of all the jobs created, of all the employers in the US, to get a better sense as to what's happening in the labor market. Now, we got this new benchmark revision last week, and it shows that the non-farm payrolls report has been overstating jobs created by about 800,000. And that's, huge, right? So the labor market is not as strong as people thought that it was. Now, people who study this seem to think that a big reason for the overstatement of jobs has been what's called the birth-death model. So again, these government agencies are trying to estimate how many jobs are created each month. However, they note that sometimes a company is just, let's say you start a company this month and you hire people, but there's a lag between when that new company shows up in the data and when they initially hired people. So to account for that lag, they have something called the birth-death model, which refers not to people, but to firms, let's say the creation of firms and the death of firms. Now, that model appears to have been overestimating the amount of jobs created, that is to say, the amount of new businesses created that are hiring people over the past year. And that model, I think, has been having trouble estimating it because during the pandemic, we had kind of a surge of entrepreneurship where a lot of people created new businesses. And now that surge in entrepreneurship probably petered down. And so the model is having trouble adjusting to just what kind of the regime there is when it comes to the founding of new firms. And so that resulted in a significant overestimation of the jobs number. Now, this could have played into some consideration when the Fed is thinking about whether or not to cut rates. The labor market is not as strong as they thought. But to be clear, Fed officials have been suspecting this already. From the Fed minutes we got the last week, it said that many Fed officials were thinking that maybe the jobs number is overstated. So I'm not sure if this number had too big of an impact since they were already suspecting this. Now, many people have also been pondering whether or not the BLS is in cahoots with the Biden administration and trying to pump up the chances of a Harris presidency. Now, to be clear, I have no idea, but I'll make a couple observations. Now, government obviously run by people, and people obviously have their own personal views, their biases. Now, we know, for example, that former president of the New York Fed, Bill Dudley, very strongly had a preference against Trump, and so far was writing op-eds recommending that the Fed conduct policy in a way to make sure that Trump was not elected in 2020. Is it the same in the BLS? I don't know. But usually, though, when you have these really high stakes issues. Of course, the presidency, the ultimate prize. There's a lot of interest involved, and that oftentimes incentivizes people to act in certain ways. So it's possible, I don't know. Now, the second thing that I would observe is that many people say that, well, let's say that the BLS was conspiring to pump up the economy. Why would they just recently announce right before November that they actually had to revise away 800,000 jobs, right? That doesn't make any sense. Now, that's totally reasonable, but I would point to the market's reaction to tell you why it would actually still make sense. Because the market did not care at all about the 800,000 down revision. The market only cares about what happens every month. So if you were to overstate the job numbers every month, the market would like that, right? But let's say later on you revise those jobs away, the market doesn't care. And so from the market standpoint, it would still make sense to overstate jobs only to revise them away simply because the market doesn't care about revisions. So again, no idea if this is happening, but just pointing out that it's possible. All right, so that's all I've prepared for today. Thanks so much for tuning in. Remember to like and subscribe. And if you're interested in my thoughts, check out my blog at fedguide.com. Or if you're interested in learning more about markets, check out my online courses at centralbanking101.com. Talk to you all next week.